Let's broaden it out now and turn to what's driving markets both here and overseas. It's inflation trends and Fed policy continuing to animate most early market moves this year, this morning, but also, of course, watch for the effect of China's reopening on to determine how the remainder of the year shakes out. Joining us with more is Luca Paolini. He's chief strategist at Pictet Asset Management. Good to see you, Luca. Thanks for being here. So we were earlier talking about the PPI numbers that we got this morning that were hotter than anticipated, which kind of maybe shakes the the conclusion that inflation, the rate of inflation is slowing down. I don't know. I mean, what do you take away from that?
No, I think we're reading too much into these monthly figures. I think the trend is still down. Energy prices are going down. Probably rents are peaking. Probably even wage inflation has peaked already. It's a very volatile series, and the trend is down. And I don't think that the market will read too much into this, to be honest.
As you look into next year, what's the biggest risk for markets, in your view? I
suspect that we're going to talk more about growth and less about inflation next year. I think the potential for a recession, I think, is probably bigger than the market expects. So I think the major discussion or debate for next year, I think, is going to be growth, and I think inflation is going to, the inflation risk probably are going to fade a little bit. And then obviously the big story for me is China. The reopening of China, we have seen a big rally in Chinese equity prices. So that's the two, I think, the two kind of, the potential, the positive side and the negative side in terms of risks.
So given that, how much dispersion of outcomes is there for next year? I mean, I think most of the folks we've talked to, most of Wall Street thinks there is going to be a decline in stocks, in U.S. stocks at least next year. But how big of a decline, I guess, is up for some debate. How are you thinking about it?
Well, first of all, I'm surprised by the consensus that seems to expect a decline in equity price, which is very unusual. And this makes me think that there is actually upside from that. We also believe that stocks in general will be under pressure, mainly because we haven't seen the full decline in earnings that we expect. So nominal growth will be much weaker, margin will be under pressure. So there will be potentially an improvement in valuation, in PE ratios, but probably not big enough to create an environment for a strong rally in equities. But we expect some positive returns, but still a weak year for equities going forward.
How do you imagine stocks will come out of the gate next year? Because it has been, of course, a weak year this year, and theoretically you should see some buying in January, no?
Yes, but I think the market has been a little bit in the last few months actually been very kind of, there was a big rally coming from what? From very low expectations. So now inflation is down. I think also the economic data has been slightly better than expected. My feeling that there has been already this kind of rebound in sentiment, and there will be disappointment in the first part of next year. That's why we expect equity prices to be under pressure.
Does that go for Europe as well? It seems as though thus far some of the, I mean, it's early in the winter, but some of the worst case scenarios for the energy crisis in Europe have not yet been realized. There's still time, I know. But how are you thinking about that region?
Well, I'm based in Europe, and we are all kind of surprised by the fact that the European economy is pretty resilient. You have seen also kind of a pickup in some kind of consumer confidence indicators. Inflation is still high, but there is feeling that it's probably falling. I think is a number of factors. I think the fact that natural gas prices have been falling significantly has played a big role. As we all know, the gas storage level is very high, so I think this winter will be probably fine. But I think that's also, by the way, in the US, that the economy has showed probably more resilience than we expected. And we still don't know if the bad news will come later on, or there is a genuine underlying trend, especially in the private sector. So that's something that obviously we'll find out sooner rather than later.
You mentioned China reopening, and of course that's a key thing all investors need to watch next year. But wouldn't that be a massive inflationary event and potentially bad for markets?
No, I don't think so. I think obviously the Chinese economy is more than 20% of the global economy, but we're not talking about Chinese growth booming. And we expect China growth to accelerate to 5%, not 10%. So I think at the margin there will be a negative impact on inflation, but I think it is probably fully offset by weakness elsewhere. So I don't see the reopening in China as a major inflationary force for next year.
Well, you will indeed be watching it. Luca Paolini, Chief Strategist, Pictet Asset Management. Thanks so much. Have a great holiday season. Appreciate it.